is about MACD, moving average, convergence, and divergence, one of the most respected trading indicators. Now, in tonight's class, I'm going to share with you a couple presentations. These presentations are not re-recorded into the recorded version of this class. So if you'd like to see these short little presentations, if you go to YouTube and look for the channel that's called Forex and CFD Education. Now, I'm popping it up on your screen right now. If you use that link, you can go to it and then look under moving averages to see the video presentations on that I'm going to share with you in class tonight. Okay. Also tonight, if you notice on your screen, there are several handouts. I've tried something new for you tonight, and it's the second time I've done it, and I've uploaded a short little video on the most popular trading indicators. Okay. It's a video on 4 different indicators and how to combine them in a strategy. It's only a couple of minutes long, but it's the first time I've ever uploaded it so that you can actually download it yourself. If you click on that download button, you'll be able to download it and then watch that video at your convenience, store it and keep it. It's a very short, it doesn't take up much space. I've also uploaded something called the presentation YouTube video link. It's the same link I gave you that you just have now, but if you don't copy it right now, you'll get it in one of those downloads. Plus, I've put together for you 3 handouts. One is the MACD indicator guide. That's going to cover all the ins and outs of tonight's class in greater detail and serve for you as a very good reference material. I've also given you the technical indicators guide from investing.com. This is an excellently written and demonstrated ebook on all the major technical indicators. And lastly, I'll give you the moving average guide. So if you're not fully understanding moving averages, because you need to understand moving averages to understand MACD, I've given you that guide also. And you can download these and keep them, they're yours. There's no charge for them, and have them as reference material for whenever you like. Now, they are not available at any other time. You can't get them in the recorded version of tonight's class. So if you don't click on those little download buttons, and you can pick and choose right on your screen, if you don't get them now, you won't be able to have access to them again. Now, in tonight's class, I'm going to use the term security, but I might also say stock or bond. I might say cryptocurrency. I might say Bitcoin. I might say Facebook. But it's only because it gets very boring saying security, security, security over and over again. I'm talking about, and the concepts we're talking about will work with any publicly traded financial instrument in which there's an open market. Similarly, I intermix the terms investing and trading. Now, we all know that we're all here because we want to be traders. And traders take a much shorter term position. Investors take a longer term position. And they're 2 different animals, so to speak. But I intermix the terms only because it gets very boring saying trading, trading, trading. And most of the techniques we're going to talk about tonight will work well for both investing and trading. But we're talking specifically, or more importantly, about trading. Now, MACD falls in the category of what we call technical analysis. Now, I think the main question I always get asked from traders is, should I buy something? Should I sell something? What will the price be later today? What will it be tomorrow? Is it going to go up? Is it going to go down? Will I make profit? Will I lose my money? Well, wouldn't investing or trading be easy if we knew the answers to these simple questions? But alas, I don't have a crystal ball and I don't have a Ouija board. And neither does anybody else. So anybody out there who tells you, do this, and do that, you're going to make money, please don't listen to. But so if you're attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you are attending this webinar with the hopes that technical analysis will improve your investing and trading, that it surely will. If you stop to think that trading is all about filters. We want to get something that gives us a buy or sell alert. Okay. We're going to get 1 million of these alerts. Okay. But then we have to start applying different types of filters to filter out all of these opportunities so that we only end up with high probability trading opportunities. And if you realize that the market is random, it just is. Nobody can tell you where price is going to be, what it's going to do, how it's going to react. Price is price is price. Price dictates the market, and it's random. But there are times within these random movements of the market that there are non-random fluctuations, non-random periods of time. And these are called uptrends and downtrends. When we can isolate these non-random frequencies, and we can find a market that is actually moving in a non-random manner, we can then apply many different types of decision-making capacity tools to find an opportunity to make profit. One of the best tools that we have, okay, in the area of technical indicators is called the moving average convergence and divergence indicator. Now, it's been around a very, very long time. It is one of the most popular trading indicators used in forex, commodities, and stocks. Now, it was originally developed by Gerald Arpel, and it was developed for the stock market. It was used to spot changes of strength, direction, momentum, and the duration of a trend. And a trend, when you can find a market that's actually moving in a well-developed trend, those are the times of non-random movement. So we're looking for something that's going to help us spot these and then help us make sense of them. So the basic function of the MACD indicator is to discover new trends and to help identify the end of the current trend. In other words, when we see a market moving in a non-random fashion, we're safe. But when it starts, that trend starts to end, and the market's going to move into a non-random movement, we want to make sure we're out of the market. Now, the thing about MACD, it's a fairly easy tool to use. The MACD indicator is typically placed on the bottom of the trading chart in a separate window beneath price chart. The moving average convergence divergence tool is relatively easy to use, but it's crucial to understand it fully before attempting to trade using its signals. Because you have to understand where all the lines that are being used for MACD come from so that you can see when they're giving you false signals or good signals. So I'm going to apologize now because we're going to get into something that's a little bit wordy and a little bit boring. But I have to do this because you have to understand what makes up MACD. You'll never have to do any calculations, and you'll never have to go through this ever again. But in order for you to look at a buy signal or a sell signal, or to realize a smooth change in momentum, or the trend change in the trend of the market, you have to understand where all these lines are coming from so that you can, like I said, spot false signals or spot when these things are doing something that they shouldn't be doing. So MACD starts out using a moving average. Okay? And a moving average is simply a line or a number that's put on a chart that uses a period of time. The MACD uses a 12 and a 26 period moving average. So what I have on the chart right now is a 12 period moving average. This is the purple line that's on the chart. Okay. And I'm going to turn this off from candlesticks over to bar charts only because it's easier to see. That's the only reason I'm doing it right now. Then we're going to add on to that a 26 period moving average. And let's see, let's make this one, we'll leave it turquoise, and we just want to make it a thick line. Nah, let's make it gold so it's easier for you to see. So now we have two moving averages on a chart. We have a 26 period and a 12 period. Now, you say, why do we use the 12 and the 26? That's the periods that Gerald Arpel developed when he developed his indicator. You can change it and use a 10 and a 30, but then it's no longer MACD, it's Barry's moving average indicator. Okay. Because we've now taken away what the inventor and developer based his entire thing on. Now, remember, a moving average is simply an average of price. In this case, we're using simple moving averages, and we're using a 12 period, a 26 period. So a 12 period would be taking the close of the last 12 time frames that you have on a chart. So we're using a half-hour chart right now. And we're using a 12 period moving average. So that means we would go back and take the close of the last 12 bars, add them together and divide it by 12, and then put a dot on our chart. And that would give us a 12 period moving average. If you don't know what moving averages are, I don't have the time in this class to really go into everything with moving averages, but I gave you the handout, okay? And we have a whole class of moving averages. The second moving average is a 26 period moving average. And again, so we go back 26 periods and add together all the closes for the 26 periods, divide it by 26, and put that dot on the chart. And we connect all the dots that we put on the chart, and it forms the lines, which gives us the gold line and the purple line or the dark blue line, whatever that is. Okay. And those are simple moving averages. Okay. If we were to use this for our trading strategy, this is a simple moving average crossover strategy. It's got nothing to do with Gerald Arpel. And moving average crossover strategies have been around forever, but they're very, very simplistic. Basically, a moving average crossover strategy tells you to buy or sell when the longer and the shorter moving averages, the 12 and 26, move above or below or cross over each other. So in other words, a simple moving average strategy is when you see the longer period moving average cross over the shorter period, you would sell. When you see the shorter period cross back over, you would buy. That's really basic. And this is the very, very beginnings of MACD. So what MACD does, or what Gerald Arpel did, is he took the value of the 12 period and the 26 period and took the 12 period and subtracted the 26 period from that. And that number, the different number, whatever that difference is then part of MACD. It's the first line on MACD. Now, MACD is dropped on our chart below our price chart, down here. So this line down here is called the MACD line. The MACD line is simply the difference of this line to this line. Now, on the bottom of our chart, we can see that we have a zero line. And then we can have values above and below zero. Because whatever the two moving averages cross each other, what would the difference be? The difference would always be 0 because they'd be exactly the same. When you subtract the exact same number from each other, you would get 0. So whenever this MACD line below is at 0, that's telling us the two moving averages are crossing. When the shorter period or the 12-period moving average is rising above the 26-period moving average, it would be above the 0 line or be a positive number. When the longer period moving average, the 26-period moving average, was rising above the 12-period moving average, it would be a negative number, because when you're taking a smaller number and subtracting a larger number, it would come out negative. So again, if we watch the 0 line right here, we see that number fall below. We can also see the bigger the differences, the moving averages, the longer periods separating from the shorter, we see it rise a lot higher and a lot faster down below, because the difference between these two lines, when we took this line, subtracted that value from that value, we would get a much larger difference. And each difference is plotted below on this chart, or this indicator chart, below price. So technically, we no longer need these two moving averages, because MACD is not placed on the price chart itself, it's placed below. And so this blue line that we see now below is the value of the two moving averages subtracted from each other, because we are moving away from the moving average crossover strategy. But if you still want to use a moving average crossover strategy, anytime that this price was at 0, we could buy or sell. If it's moving at 0 and above, we would buy, and moving at 0 and below, we could sell. But still, that's really still basically the moving average crossover strategy, and it's a very simplistic strategy. But this is just the first step in MACD, because MACD is a derivative of a derivative of a derivative of a derivative. So what Gerald Arpel did is he took the moving average crossover strategy and formed what's called this MACD line. So this single line down below is called the MACD, and that's all it's referred to as the MACD line. He then goes one step farther, because he doesn't want a simple moving average crossover strategy, and he takes a 9-period simple moving average of the value of this line and charts that as what we call a trigger or a signal line. And that is now the gold line that I put down below. So it is a 9-period moving average of the value of the blue line, or the MACD line. So the MACD line was at 0, 1, 1, 1, 1, 1, 2, 3, 3. For 8 periods, it would add that together and put it on the chart as a simple moving average. Now this simple moving average, which is the gold line that we put on here, is called a trigger line or a signal line. When it crosses the MACD line, it gives us a buy or a sell signal. So we're no longer using just the moving average crossover strategy, because we're not paying attention to the 0. We're paying attention to the difference between the MACD line, or the crossover between the MACD line and the signal line. Now, we go one more step, and this is called a histogram. This histogram is charted using the difference of the value between the MACD line and the MACD signal line. Because when those two lines cross over, what are they at? Their value is 0. When the MACD line is larger than the signal line, it moves upward in the positive numbers, and when it moves below, it's in negative and negative numbers. And the depth of that move also shows you in the histogram the peaks and the valleys. Now, even though if we were to turn back on all of these lines, we'll see that they look pretty much the same. We can see, oh, look at that. We have the 26 period move, the 12 period moving average rising way above the 26, but at a slightly different pace because we got the crossover or the buy signal here on our MACD line. We didn't get the buy signal to here on the moving average because the MACD line, the MACD removes the lag time. It gives us a little bit more predictability. We can also see the loss of momentum. We can see the price was soaring up and then lost its momentum and turned back down. We can see that in the histogram, but we can see the depth of that momentum, and we can see where that momentum starts to wane in this histogram. Even though it hasn't fallen off, we can see the momentum of this downtrend is easing off over this period. We can see that here we got a crossover, which would have been a buy signal in a simple moving average crossover. But here we didn't get a crossover. Okay, so here we didn't get a buy signal triggered. Okay, we have very little momentum in the move, and therefore we wouldn't have bothered to enter into a trade. And MACD didn't actually give us a trade signal. So MACD becomes a little bit more predictive and reliable than a simple moving average crossover strategy. And it becomes a derivative of derivative of a derivative of a derivative. But it becomes more reliable. So let me take these back off the chart. Now, a lot of traders will use MACD just as you see it below. I, on the other hand, only use the histogram because everything and anything you need to use or know is in the histogram. And you can actually trade from the histogram as opposed to trading from the price chart. Because this histogram tells you just about everything and anything you want. Okay, but most traders use, because they want to see more, they use the 3 together. Now remember, whenever you have the crossover, you get a buy or a sell signal. You get those when, if you use a 0 line, if you're not using the actual lines, whenever the histogram crosses the 0 line, or if you want to see it visually, whenever the MACD and the MACD signal line cross each other. So this is it. Now you have MACD on your chart. You never ever have to do this ever again, because if you want all of this, just like we went through it all, on your charts, all you do is go up to indicator, scroll down and look for MACD, and click on it, and it's going to drop it right on your chart with the 12, the 26, and the 9 moving average. It's going to, because this is the standard formula. Now, there's gurus out in the marketplace that are telling you, make this adjustment, use a 12 and a 26, and use a 14-day average. Okay, you can do all of this, but once they get modified from Gerald Arpel's 12, 26, and 9, they're now whoever. So the rules don't fit. So you have to back test it or follow exactly whatever that guru is telling you. But now we have MACD on our charts. So we have our price chart. I'm going to change it back to our candlestick chart. We have our MACD on the chart. That wasn't so painful, was it? Well, now we have it on the charts. We have to figure out what to do with it and how we can use this correctly. So let's go back to my PowerPoint. And let's talk about using MACD. So again, the concept behind the MACD is fairly straightforward. Essentially, it calculates the difference between an instrument's 26 and 12 EMA, and the two averages makes up the MACD. We subtract one from the other plotted below, and then we form the MACD histogram. And the MACD histogram is an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD is above its 9-day moving average, and negative when the MACD is below its 9-period EMA. Now, the moving average convergence and divergence indicator is both a momentum oscillator and a price-based oscillator. Now, oscillator is a field of technical indicators. An oscillator is one that oscillates between a price level. Now, we have bounded and non-bounded oscillators. MACD is non-bounded because the value of MACD is whatever the numbers are. Where RSI and stochastic are bounded, their formulas will always come out between 0 and 100. MACD is always going to be just the difference between, so if Bitcoin surges sky high and the difference between the 12 and 26 is $800 or $800, that's what the difference of MACD is going to be. Okay, it's not bounded anywhere, but it oscillates up and down over top of the 0 value. Now, you can notice on this chart that MACD helped traders notice that a trend change for a very early stage. The key part of this indicator, and something we will develop in much more, is the MACD trigger line. MACD will cross the 0 line and a faster moving average intersects the slower moving average. When it crosses that moving average at the 0, it's also telling us the trend is changing. So MACD gives us 3 stories. Okay, it gives us crossovers, which we've been watching. Crossovers generate transaction signals, buy and sell signals. It gives us overbought and oversold conditions. So when we get the high peaks and the peaks and the valleys in the indicator below, when it peaks very, very high, it's telling you the market's getting overbought. When it falls very low into the valley, it's telling you the market is oversold. And lastly, it gives us divergence. So the basic MACD trading rule is to sell when the MACD falls below its signal line. Similarly, a buy signal occurs when the MACD rises above its signal line. It's also popular to buy and sell when the MACD goes above or below 0. It's either the same way. So let me share with you a little presentation on MACD. So we can actually see it in action.
How fast the indicator is going to react to price change. Most of us will probably be chopped to pieces if we rely on only a short-term trading indicator as the basis for any trading system. The MACD line is faster than the signal line, and it's the result of the difference between the fast and the slow moving average. Many traders will use the line as a proxy for momentum, But to make it simpler, think of it as measuring the rate of change of price. The signal line in the MACD is slower due to its setting, and traders are often use that as a trend determination tool, either using multiple time frames or just one trading chart. And knowing that we measure trend and momentum, you may already see how we can use the MACD to actually trade with when we use both the MACD line and the signal line to alert us to possible changes in the market. The two-line cross can be a powerful indicator of trading potential in the market. Here we've set up the indicator on our chart, and we're going to use the standard settings as we talked about earlier, and we're going to read the MACD. When we want to determine trend direction via the MACD, we can look at where the MACD line is in relation to the signal line. If the MACD line is below, in between the red lines on the chart, we're looking for a short trade. If we see the MACD line is above the signal line, between the green line, this is going to indicate a market in an uptrend, and you'd be bullish on any trading setup. And as mentioned, we're really looking at the rate of change of price. So even though the lines are crossed, price may be compressing. This is one reason that multiple time frame trading is suitable for this trading indicator. You simply look to short rallies during a MACD downtrend and buy pullbacks during an uptrend. And some traders will use the MACD signal line crossovers to buy or sell the market. You may want to consider other variables such as price structure, multiple time frame considerations, and price action in conjunction with trading a simple cross. Once the MACD line crosses over the signal line to the downside, that would be bearish, and you could use that as a signal. Conversely, if the MACD line crosses to the upside, you'd be bullish, and you can use that as a buy signal. And we talked about the fast line being a proxy for momentum, and there may be times where we will not want to wait for a complete crossover of the MACD to take a trade. So I want to draw your attention to the black round circle at the top of the chart. Here's a pin bar, and it formed after a run-up in price. Also notice the separation in the MACD indicator as price approaches the region, in the same region of previous resistance that's not really seen on this chart. And it shows decent momentum in this market. We see the separation decreasing as price slows down and then explodes to the upside, but closes on its open as seen on the pin bar. This is bearish. Now bring your eyes to the fast line of the MACD, and you can see it hooked to the downside. Given the context of price action and structure, you could gain an early entry into a possible reversal. Depending on the context of the chart, you can use the fast line hook as a buy signal or a sell signal. These can be used to enter the market or as a profit-taking indicator, but doesn't matter. Well, this is a weekly chart, and you would have entered 5 or 6 bars earlier, and you've been up over 120 pips before that breakdown happened. What about divergence? I'm not going to talk about divergence, simply because this also takes into account price action and structure, and I find the normal teachings about divergence has way too many holes, because if you trade just the indicator, you're setting yourself up for a failure. Another way that we can use this indicator is to take advantage of the zero line and the fast line as a means of trade entry. Again, keep in mind the lagging nature of all indicators with this trading method, and highly consider using multiple time frames for your trading. You can see the change in trend when during the moving average crossover, so we know we're looking for a short trade. Once the fast line crosses the zero line, this could be a trade entry. You can see how mechanical this is, but it also gets you in very late in the move. You can see on the inset on this graphic that this is the daily chart, and the red line indicates where, after the weekly trend turns down, you would enter on the daily chart using the zero line cross. That black line is where you'd enter on the weekly chart 2 months later. So in summary, with the MACD, we do have a useful technical analysis tool. It has quite a few uses, and we talked about how to determine the trend using the 2-line cross, how to read momentum using the fast line, trade entry using a fast line hook, trade entry using a zero line cross, the benefits of multiple time frame analysis. And as with all technical indicators, you want to test this as part of an overall trading plan. Also, be aware of the lag time using this indicator, although for some traders, it'll be an advantage as you're not picking tops and the bottoms.
Now remember, MACD is a derivative of a derivative of a derivative of a derivative. Okay. The first derivative is the 12-day EMA and the 26-day EMA, the first 2 lines we put on the chart. The second derivative is the MACD line, which is the 12-day or 12-period EMA less the 26-day EMA, or the 26-period EMA. Then we put the MACD signal line, which is a 9-day EMA of the MACD line itself. And the fourth derivative and the final derivative is the MACD histogram, which is the MACD less the MACD signal line. So the base of this indicator is the securities price. It takes 4 steps to get to the actual price to the MACD histogram. So that's a great deal of massaging data. While not necessarily a bad thing, chartists should keep in mind that when analyzing, keeping this in mind when analyzing the MACD histogram. It's an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in the price momentum of the underlying security. So the first thing we get from MACD are transaction signals that cross over to the buy and the sell. Okay. We can also look for the center line movement, the zero line, because as price moves up and above that zero line, it's gaining momentum, or falling below that zero, we can see it losing momentum. So that means we're in a downtrend, and we can see how that momentum is building, whether it's a downtrend or an uptrend. So we can track momentum, which is very important. The thing you have to remember about MACD is not a standalone indicator. There should be never a standalone indicator. You should always be using trend line, support and resistance, and other pieces of information. But if you notice, not one point in this conversation have we discussed, number one, actually buying. We talk about alerts because the MACD gives you buy opportunities or sell opportunities that you have to then decide, because MACD doesn't tell you how much the asset will move. It'll tell you the direction. But you can get, in a price movement, you can get whipsawed in and out of a zillion trades, because MACD will give you a buy signal, and it'll give you a sell signal, and give you a buy signal. So if you're not using other filters, you can get whipsawed in and out, because even though MACD gave you the signal to go long and the price moved up, by the time you were to cover the spread and by the time you would enter the market, you could end up with a small loss per trade, because MACD doesn't tell you how far it's going to move. So therefore, you need to be looking at other pieces of information. So the biggest disadvantage of using this indicator to generate transaction signals is that a trader can get whipsawed in and out of a position several times before being able to capture a strong change in momentum. So traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets, because relatively small movements can cause the indicator to change direction quickly. The large number of false signals can result in a trader taking many losses. So when commissions are factored into the equation, the strategy can become very expensive. That's why you should only use it as an indicator of a buy or sell opportunity, and then you should be applying other pieces of information. Okay. Now I'm going to show you a short little presentation on how you could use several indicators to interpret MACD, or use them in conjunction with each other.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average, convergence, divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter term moving average is above the longer term moving average, this area of the indicator will show activity. When the shorter term moving average is below the longer term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market and may use it as a signal to exit a trade. Indicator 3. Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of the time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4. Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5. Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction.
So as you can see, the MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. And what's unusual about MACD is it works for us as traders in very short time ranges. A lot of indicators are not good for 5, 10, 15-minute charts. They don't react fast enough. They give us too many crazy signals. MACD adjusts itself very quickly, so it works very well for us in short-term time frames. Now, the clear transaction signals help minimize the subjectivity involved in trading, and the crossovers of the signal line make it easy for traders to ensure they are trading in the direction of the momentum. Very few indicators in technical analysis are proved to be more reliable than the MACD, and this relatively simple indicator can quickly be incorporated into any short-term trading strategy. And on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. If you want to get more information about using MACD or see it in action and see actually, there's a lot of MACD strategies out there. If you go to www.ubcfx and click on their education tab, you'll be able to see all the strategies involving MACD and watch little video presentations on each one of the different types of strategies you could use. Or you can talk to somebody at UBCFX who will give you some one-on-one personal time to explain the indicator better to you. So I'm going to give you a minute to click on the download buttons to download all of those little handouts I gave you so that you do have them, and to make sure you get the link to the these little presentations I've shared with you in the webinar tonight. And on that note, I'm going to say good night to you and thank you very much for joining us. And I hope you learned a little bit about MACD tonight. Thank you very much. And remember, try a demo account at UBCFX and try out MACD. They have great charting, chart tools and advanced charts at UBCFX, and you'll be surprised how easy they are to use. Have a good night now, and we'll talk to you again real soon.